Welcome to Get Rich Education. I'm your host, Keith Weinhold. President Donald Trump's tax plan versus Democratic presidential nominee Joe Biden's tax plan. Which one would benefit consumers like you and investors like you the most? And we're joined by a great guest today on Get Rich Education. Congress just made it possible to get up to $100,000 out of your current 401k or TSP to invest in real estate, gold, or even your own business. That's even if you're still working, and avoid the IRA UBIT tax. The thing is, you can get your money tax and penalty free for a limited time. The eQRP is your secret weapon. With the CARES Act expiring soon, the eQRP company helps you unleash your retirement funds now. Learn more and text message eQRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from London, England to London, Ontario, Canada, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. Now, when we talk about the history of taxes and proposed tax changes, whether that's in the United States or really any of our 188 listener nations, you know what you need to be really careful about when it comes to taxes taking more and ever more of your hard-earned dollar? That thing is new taxes. Look, more than 100 to 150 years ago, the income tax did not even exist. Can you imagine then earning $40 an hour for 40 hours a week and actually getting a paycheck for all of that amount, $1,600, with no income tax or anything else taken out? It's kind of like when a camel first gets its nose under the tent. See, about 150 years ago, we introduced the very first income tax rate at just 3%. Well, the camel getting its nose under the tent is just the start of lifting up that tent, because now the income tax rate is 12 to 13 times the amount of 3% when it was first introduced. Later on, a capital gains tax came along. Well, now that it's here, it's not going to go away either. When you receive a capital gain, what you've done is simply profit from the sale of an asset. That's what that means. The capital gains tax rate is basically between 15 and 20%, which is probably lower than your income tax rate. A lot of times people misspeak when they discuss this topic. They talk about paying capital gains. No, you don't pay capital gains. No one ever has. You want capital gains. A capital gain is your profit. What people mean to say is that you want to avoid paying capital gains tax. Now, when a real estate investor has a capital gain, again, that means your profit from the sale of an asset. Well, that real estate investor can defer their capital gains tax over and over and over again. You can do that for the rest of your life if you structure it correctly, like with a 1031 like-kind exchange. I've told you many times on this show how I've legally never paid a dime of capital gains tax in my 18-plus years as a direct real estate investor. Now, Joe Biden has made remarks that he wants to remove that 1031 exchange benefit for real estate investors. I don't think that's going to happen, because previous presidents have said the same thing, that they're thinking about removing it. But yet that benefit persists. It hasn't gone away. Now, for wealthier people, there is also something called an estate tax. What an estate tax is that it's a tax levied on the net value of the estate of a deceased person before distribution to their heirs. That's what it is. When you die, the value of your assets are taxed before you pass it on to your heirs. Tom Wheelwright is going to join us shortly to discuss the differences in the plans that Donald Trump and Joe Biden have for each of these taxes and more. But first, an interesting real estate story to think about is that at the current pace of home sales, it would only take 3.3 months to run out of real estate inventory in America today. And as you know, 6 months of inventory is a balanced market. So this supply and demand mismatch is just continuing to push prices skyward. In fact, it was just reported that the median existing home price is up to nearly $311,000. That's an 11.4% increase year over year. Again, you've got to keep in mind that people desire larger homes today, so that helps push up that median value. And therefore, on a square footage basis, maybe prices are up only 8 or 9% per annum, not 11.4%. Shadow demand has been exposed. This demand is now out in the open. With the low interest rates and the pandemic, the buyers are out in droves. In fact, there's an open house right across the street from where I live currently. I see all the foot traffic in and out of there. Well, the question that a real estate investor needs to ask themselves these days is, will shadow inventory get exposed next year to meet this shadow demand? Is a bunch of inventory going to come on the market? And what I mean is that with the economy still in the basement, some people are straining to pay their mortgages. You need to understand that some homeowners will have gone 9 months without making a payment as soon as the federal foreclosure and eviction moratorium expires at the end of this year. Now, first of all, you've got to feel sorry for some people that could lose their homes, but you might just be looking for a rental home that cash flows at GREturnkey.com. You need that inventory. So if the foreclosure moratorium expires and now homeowners have no foreclosure protection and homeowners that can't pay their mortgage lose their home, maybe that would finally free up some inventory here in a nation where we are still undersupplied by more than 2 million housing units. In the meantime, one place you can find inventory at GREturnkey.com is with the 3 Florida providers there that offer new construction homes. Other providers there are in new construction now, like the Alabama providers there. Of course, there's existing construction property at GREturnkey.com as well. There is just less of it. Let's talk to Rich Dad tax advisor Tom Wheelwright about Trump versus Biden tax plans. I'd like to welcome a familiar guest back onto the show, the founder of Wealthability. He's an expert in helping you permanently reduce your taxes. He's the author of the revolutionary book, Tax-Free Wealth. I'd like to give a big GRE welcome back to Tom Wheelwright.
Thanks, Keith. It's always good to be with you and on your show. Absolutely terrific.
You've given so much value to our listeners over the years now, Tom. Now, for some backstory, before we compare the current tax structure under Trump versus the proposed Biden tax plan in case he gets elected, Trump generally wants to preserve the Tax Cuts and Jobs Act of 2017. That's the Trump tax plan. And historically, Biden's proposed tax plan would be quite an increase. But before we talk about Trump's versus Biden's long-term tax plans, Tom, let's talk more about coronavirus stimulus, the relief there, because the CARES Act, that expired at the end of July. That had things in it like stepped up unemployment compensation and the Paycheck Protection Program and so on. And it seems to me that the chances of Congress passing another COVID emergency aid bill before the election are dwindling. What are your thoughts?
You know, it's interesting because the Federal Reserve Chairman, Jay Powell, and Mnuchin, who I think is pretty much Trump's right-hand man, both have really been pushing for additional stimulus. There's a lot of discussion about this going into a depression if we don't get some new stimulus. I know that there's a lot of fiscal hawks out there. You know, this is always the question, right? Do you have the stimulus now and pay for it later, or do you just have a long-term depression? Which seems to be the choice. It's interesting that the Democrats have chosen we'd rather have nothing than to just take care of the immediate concerns like unemployment, evictions. And then the Republicans have said, well, we don't want a bigger plan because we don't want the deficit to grow by $2 trillion. We want it to only grow by $1 trillion, which I think the difference is inconsequential. Frankly, I think it's needed. If Trump wants to get reelected, I think that's why he's pushing it. He's really done everything I think he can do executive order wise. He's got eviction stopped by executive order. He's got, which I know is painful to the landlords, but he's also did the $300 a week for several weeks, which just ran out in Arizona here. It's going to be interesting. I just never know. I think you're right, though. I think it's a little doubtful. By the way, the CARES Act, certain things ran out, but certain things are there. And certain things we do need to pay attention to. One is the PPP loans. Yeah. So there's an interesting idea here. A lot of people, they're coming up on their 24 weeks. So they need to be looking at this right now to determine, do they need to hire people? They ought to be starting to calculate this. Even though the banks aren't accepting forgiveness applications, I think a lot of businesses ought to be calculating their forgiveness to see if there's something they can do before their 24 weeks is up. Okay, so that's one thing. Another thing is that the tax provisions in the CARES Act are here through the end of the year. So the NOL carryback, the qualified improvement property, which is a permanent change, allowing that to get bonus depreciation, that's a big one. The $500,000 limit, I think, is a teeny tiny one, but it could affect some people, certainly when it comes to the carryback. And certainly the $100,000, I mean, this has got to affect, I think, a lot of our listeners here. The $100,000 that if you've been affected by COVID, being able to take out of your IRA or 401k at really generous tax consequences. Right. That's one that people ought to really be looking at between now and the end of the year, because if you had COVID or you get COVID, you get to take it. Or if you had to reduce your hours or the hours of your business because of COVID, then you get to take it. And who knows what's going to happen. I mean, we could have some more partial shutdowns, and even a partial shutdown qualifies. We'll have to see what happens, but people should be thinking about that one.
And extending a lot of these CARES Act sort of provisions, sure, that is going to lead to ballooning deficits and debts. But then, of course, the alternative is austerity, which is probably even less palatable as an option. Many think that if Biden wins the upcoming election, it's more likely that more stimulus is going to be created for the coronavirus relief. What are your thoughts?
That's only true if the Senate goes Democrat. And the reason is because Trump wants the stimulus too. So Trump's not holding up the stimulus. It's the Republicans in the Senate that are holding up the stimulus. Trump absolutely would be very happy with the $2.2 trillion that the Democrats have proposed. He said as much. I don't think it's going to have an impact if Biden gets elected. I think what's going to have an impact is if the Democrats take the Senate.
Well, let's start looking at the longer term here, Tom. Historically, Biden's proposed tax plan, it really would be quite an increase. We can work through some of what Biden proposes here. And when I say historically, I mean, looking back over time, it was things like the Revenue Act of 1941 and 1942 that basically helped fund World War II, that really created an increase in revenue through stepped up taxes. So I don't think Biden proposes anything that's going to be that expensive, if you will, but it does step up the taxes a good bit. So I think when it comes down to taxes, the first one that people think of is what they see on their paycheck stub, and it is that top tax bracket, which is currently at 37%. So tell us about what Biden proposes.
And let's step back just for a second, if we could, Keith, because people need to understand the context. First of all, the president doesn't enact tax law. Congress does that. I'm going back to Obama, and in Obama's budget, every year for 8 years, he had in there eliminating the tax benefits for drilling oil and gas wells. They're still there. So the fact that Biden proposes it or wants it doesn't mean it's going to happen. That's rule number one. So then what we need to look at is, of the things that Biden's proposed, they can be broken down into two categories. One is raising tax rates, and the other is changing tax provisions. Of those two, raising the tax rates is the most palatable and probably the easiest to have happen. And in fact, I think it's likely. And I don't think it's going to have a big impact on the economy. At least the individual tax rates won't have, I don't think, a big negative impact on the economy. Because, for example, he's proposing changing the 37% to 39.6%. Well, that's what it was before. I actually thought it should never have gone down because I just don't think you benefit the economy by doing that. That was really a political thing for Trump supporters.
When Trump moved it from 39.6 down to 37, where it is
right,
now.
When he moved from 39.6 to 37, that was a nod to his constituents is all. And pushing it back up is going to be inconsequential. Keeping it under 40%, that's consequential. That's a magic number. There's a reason it's under 40% because when you get over 40%, people start looking at tax shelters. They spend more effort on their taxes when it gets over 40%. So that's why he's not proposing putting it up over that. He also wants to add increased tax rates for people making over $1 million, people making over $5 million. That's actually not a bad idea. If you're going to raise revenue, that's probably the least painful from an economic standpoint. Now, it's not a huge amount of money, right? Let's face it. What is a much bigger number is raising the capital gains rate. And he's proposed raising the capital gains rate to ordinary income rates when your adjusted gross income is over $1 million. Here's the biggest issue there. I don't know anybody's talking about this. What is a capital gain? You know, we had these carried interest rules that changed in the 2017 Tax Cuts and Jobs Act. And what they did was they said, well, now you have to have the carried interest for 3 years. The question was, in the committee reports, these are the reports of the people who are proposing the law, it was very clear that it applied to real estate. But when it came out, the law actually didn't apply to real estate. It appeared to exclude real estate. And then when the IRS issued regulations this summer, they excluded real estate and they excluded businesses. So here's the question. When Biden says he's going to raise the capital gains rates, is he talking about stock market capital gains, which is one code section, or is he talking about business and real estate capital gains, which is a different code section? If he's talking about the stock market capital gains, I think it has a very small impact on the economy. I just don't think people make decisions about selling stocks, whether long-term, short-term, et cetera. I think they're either selling them or they're not based on the market. That is not true with business and real estate. That's going to be something to watch, okay? Now, granted, most people aren't be watching it, but I will be. So I'll let you know what happens there, because that's actually a very critical point, because what you don't want is you don't want to put a big burden on the real estate market from a transactional standpoint, and you don't want to put a big burden on business from a transactional standpoint. Putting it on the stock market, I think that's a little easier. The Tax Foundation, which is a think tank that I actually have had on my podcast and that I read a lot, they're really good.
Yeah, I check out the website at times.
Yeah, Tax Foundation. So the Tax Foundation, they suggest that the worst tax increase for the economy and for the average person, surprisingly enough, is raising the corporate tax rate. And that's really interesting because I would not have thought of that. I would have thought that would be the easy one, right? Raise it from 21 to 28, which is what Biden's suggesting. How big an impact does that have? The biggest impact is that you're taking, right now at 21%, we're effectively a tax shelter country. We're a tax shelter country. So remember, that's the only tax rate that they made permanent in the Tax Cuts and Jobs Act was the corporate tax rate. All the others were temporary. They're set to expire in 2026. The corporate tax rate does not. Here's the reason for that. Because corporations have a lot longer range plan than individuals. And so corporations, they can't move easily. The whole point of the 21% rate is not to benefit U.S. companies. The whole point of the 21% rate was to encourage foreign companies to relocate to the U.S. The worst thing that's happened in that regard were the Democratic presidential debates, where every single candidate said, we're going to increase the corporate rate. Well, what that does is that puts foreign companies on notice, we better not do this. That's actually a major issue for the economy. Is you talk about raising the corporate rate. Once you raise the corporate rate, there's no way. If you get to 28%, we're like every other country. Now, are we competitive with other countries? From an income tax, we are. We're completely non-competitive from a value-added tax because we don't have one and they do. All other countries have a value-added tax. So we're not competitive there. So we're not even addressing that competition, but we're competitive corporate, but we're not going to attract anybody. Nobody's going to move here with a 28% corporate tax rate.
28. Maybe they would for 21.
They'll move for 21. Remember, Trump wanted 15, would have absolutely brought people in. Absolutely, without question.
Right. What a magnet. What an attraction that
would. It would have been a huge magnet. I mean, look at Ireland. I mean, look who's in Ireland. Google's in Ireland. Apple's in Ireland. Right. Medtronic's in Ireland. All the big tech companies are in Ireland. Why? Because they have a 12% tax rate.
Yeah, that's a substantial difference.
It is the only reason to be in Ireland. Why would you be in Ireland? It's a little tiny island on the north of France. I mean, come on.
There's one reason. And individuals can be more nimble than corporations. So corporations need that sense of certainty and permanency with the tax rate before they make those big scale decisions. Well, you covered an awful lot there. So with the top tax bracket currently being 37%, Biden proposing it run up to 39.6%, because psychologically, if that's a federal rate of 40% or higher on your income taxes, then once it gets higher than 40%, people realize they're only keeping 50 some cents of every dollar earned. And of course, Californians can probably take less consolation in this because their top income tax rate is 12.3% on top of the 37 already. So if Biden,
they're talking about a 16.8% rate.
Yeah, they're talking about hiking theirs too. But if Biden hiked it up to 39.6% in California, you already pay 12.3%. So a Californian, therefore, if Biden were elected and he got his wishes through Congress, they'd already be paying 52% or so in California, keeping only 48 cents of every dollar.
Which is what they were paying before 2018.
Right. That's a good point. Yeah, they had been previously. And we talk about capital gains tax, 1031. That's a tax-deferred exchange.
1031, by the way, there's been a lot of discussion in real estate. I do not think that will go away. I don't.
So a short-term capital gain is a profit from an asset held for less than a year, and a long-term capital gain is a profit from a sale of an asset held for more than 1 year. So that's what Biden proposes to do, to take short-term capital gains tax rates, which are currently higher because they're the same as your ordinary income tax rates. And then long-term, Biden would want to take your long-term capital gains to ordinary income tax rates as well, which would be hiking them basically beyond the 15 to 20% that long-term capital gains are taxed at now. 1031 tax-deferred exchange. That's a valuable tool for real estate investors. Previous presidential administrations had threatened to remove it.
What the 1031 exchange does is provides liquidity in the real estate market. That's what it does.
Yeah.
And you don't want to take that liquidity out of the market. That would be a really serious change. And I just can't see Congress going along with that. I can't.
Because previously, I think Obama had proposed at least making limitations to the 1031 tax-deferred exchange. And then when Trump came on, actually limitations were imposed on the 1031 tax-deferred exchange. But for real estate investors, things essentially have not changed.
Right. Well, what Trump did was in the 2017 Act is they eliminated the like-kind exchange for personal property. So the big impact, which is interesting because I've never seen anybody really talk about it, is you can't now trade in a business car and not pay tax. That trade-in is taxable when you trade in a business car because it used to be a 1031 exchange. It's not anymore. I'm not sure people are reporting that, but that's not a non-taxable exchange anymore. So you're right. Trump did, and cattle, livestock used to be exchanged all the time. And that was subject to 1031 exchanges. And that went away because they're personal property. He did actually make the changes successfully, but real estate, it's a tough one. I would just be a little more surprised to see that one.
It's been threatened previously that is going to go away. It still hasn't gone away. Well, we're talking about the capital gains tax, long-term capital gains being taxed at ordinary income, potentially, if Biden were elected. We're only talking about those that make more than $1 million of adjusted gross income for that to apply. Is that correct?
That's what he said. Here's why I brought up the point about does it apply to business and real estate or not? Because let's take an apartment complex. You're always going to have more than $1 million. Now, if you split it up among the investors, maybe it's not. You still stay under that. Let's say that you own a fourplex, you could easily get up to $1 million. The bigger issue is business, because you sell a family business or you sell your business. You know, you've worked your whole life to build your business. You sell it, and in California, you pay a 53% rate. Are you kidding me?
Oh, yeah. I mean, just look at the federal alone. I mean, this is how I see it. If capital gains tax is taxed at ordinary income and that rate goes up to about 40% for the business owner that's worked hard to innovate and take risks and hire employees, if that business owner takes a startup from ground zero and they sell it for a $5 million gain, $2 million of that $5 million goes to the government. They only keep 3.
Yeah, it's a pretty big hit. It's more than that because, of course, you've got state taxes too. So it's a pretty big hit to do that, hopefully. The good news is they've actually now we have a law that says that distinguishes between stock capital gains and business real estate capital gains, which is the carried interest. And hopefully they will carry that through. It's just a possibility. I'm just crossing my fingers that if he does raise the capital gains rate, it only applies to stock market gains.
I hope so too. You're listening to Get Rich Education. Our guest is Wealth Ability's Tom Wheelwright. More when we come back on Trump versus Biden's tax plan. I'm your host, Keith Weinhold. Most rental property investors choose either positive cash flow or home price appreciation, but one real estate market can provide both. Jacksonville, Florida, with 9% lower home prices than the national median, 1% higher gross rents, and Jacksonville has appreciated 34% more than other comparable cash flow markets since 1991. Get positive cash flow today and appreciation for tomorrow. To invest for cash flow and growth in Jacksonville, go to cashflowandgrowth.com. The people that our listeners can't stop talking about are Ridge Lending Group and MLS 42056. They provided you with more loans than anyone. It's where I got my last few loans, and they finance single-family income property up to 4plexes. They're the #1 lender for both beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and you'll end up with your custom plan for expanding your cash flowing portfolio. Start at ridgelendinggroup.com.
Check this out, G. This is Flavor Flav in the building for my man Keith Weinhold to your powerful Get Rich Education podcast. And you reached 3 million listeners? Congratulations, man, on your podcast. For you, Keith, rock the house, G.
You're listening to the show that's created more financial freedom for busy people just like you than nearly any show in the world. This is Get Rich Education. I'm your host, Keith Weinhold. We're talking with Tom Wheelwright about Trump's tax plan versus Biden's proposed tax plan. And some of this, Tom, centers on the estate tax. Tell us about that.
So you'll recall, first of all, if you go back, Obama actually raised the exclusion on estate tax quite a bit. And then Trump raised it again. So right now, very few people pay estate tax. I mean, you've got to have, as a married couple, you have to have over $23 million in order to pay estate tax. A lot of people aspire to that, but it's pretty easy to avoid. Biden wants to reduce that, and he wants to reduce it to $3.5 million per individual. And if there's one other change he wants to make. So just reducing $3.5 million, it's okay. It's been to $3.5 million before Obama. You know, it can go back to $3.5 million. We can always plan around that. The biggest change, you have tax rate changes, but you have fundamental changes to the tax law. Biden's tax rate changes, I think they're not the end of the world. But what he wants to do is basically eviscerate the tax law, the way it's worked for the last 60 years. And that I'm troubled by, because that would have such an impact on economic activity. Just because it's a big change, not because it's good or bad, but because change by itself causes big upheaval. For example, he'd like to get rid of bonus depreciation. Could we get rid of bonus depreciation in real estate without having a huge impact? Yeah, we could. I mean, that's actually a tough policy argument to say that it's okay to do that. But on regular equipment, manufacturing equipment, bonus depreciation is common throughout the world. Okay, that's a common. He wants to change that. He wants to pull back on that. Another thing he wants to do, though, is fundamentally change the estate tax, which has been tried before unsuccessfully. What he wants to do, if you'll recall, Keith, most of our listeners know this, when you die, any unrealized gain, in other words, any appreciation in your assets, once you die, the income tax goes away.
The basis steps up for your heirs.
Because your basis steps up. Biden wants to eliminate the basis step up. I want to give you an example. You talked about the capital gains.
Yeah.
Let's say you had a business owner he has a $10 million business when he dies. Now he's got an estate tax because only $3.5 million is exempt, which means in order to pay the estate tax, he has to sell the business. But when he sells the business, he has a $10 million capital gain. So when he sells the business, he has a $10 million capital gain, which is going to be taxed at 40%, maybe 50% if you include state taxes. Plus he's got a 40% estate tax. The family could end up with less than 20%. So basically it's a confiscation of wealth.
That's astounding.
And I don't think it'll happen. And part of the reason I don't think it'll happen is because it was actually proposed and enacted back in 1980. I'm old enough. I remember these things. And they could not get it to work, and they reversed it before it ever got implemented. So not having that basis step up is a big deal to people, and it's especially for small business owners and real estate investors. So to me, that's a lot scarier than the 1031 exchange.
Yeah, completely. I understand. Incomes over $400,000 would be subject to Social Security tax under Joe Biden's proposed plan. That tax is 12.4%. Typically, that's divided between employer and employee. Tell us more about that.
That's an interesting one. I don't understand donut hole he wants to create between 140,000 and 400,000. If you're going to do that, just make the whole thing, just take the cap off. You can make the argument that, look, we're just going to finally admit that there's no difference between Social Security tax and the general fund, because there isn't. They say Social Security is going to go bankrupt. No, it's not. It's all in the general fund. So, I mean, that's a ridiculous argument. Social Security is never going to go bankrupt. The government's going to go bankrupt, but Social Security by itself, that's like, which account do I put it in? For an accountant, that's not an interesting argument. And then this is what Liz Warren, Senator Warren, had suggested, right? She said, let's just take the cap off completely. That's a big number. Now, here's the good news. If you do planning right, it's fine because it only applies to wages and self-employment income. And seriously, I don't know very many people who have a business that actually have wages from their business of $400,000. I don't see that being a big issue for business owners and real estate investors. It's more of an issue for high income earners.
Right. So therefore, if someone had an income of $1 million a year, they now need to pay Social Security tax above $400K. That'd be $600K of income that they need to pay this extra 12.4% Social Security tax on. That's another $75K right there, just to give some example of how this would look and what kind of obligation that would incur. Well, there are a number of other interesting things that Biden proposes. Any of those that you want to touch on, Tom? For example, Biden wants to raise the minimum wage to $15. Trump does not. Biden proposes forgiving student debt for poorer graduates. Anything there that you think is going to have an impact?
The general context of it is important. I personally am a fan of the minimum wage. I think minimum wage ought to be a wage and have a livable wage right now. This is my personal belief, which is what they do in Australia. My theory, Australia has very low crime. My theory is one of the reasons is because their minimum wage is high. I personally believe there's some correlation there, so I'm not personally opposed to that. What I'm more concerned about is Biden wants to fundamentally change the essence of the tax law. Right now, the tax law it's a series of incentives for business owners and investors. I've said that before on this program. And what he wants to do is eliminate the incentives for business owners and investors and instead provide social incentives. So he wants to take the economic incentives out of the tax law and provide social incentives. Well, the challenge for that is that the tax law is an economic engine. It's not just an economic engine for the government, it's an economic engine for the economy. If you do that, you have such a major change in policy. I think we'd be in a world of hurt in the economy in the world economy. It would affect the global economy. That would put us more on par with Europe, which is what Biden and especially the more left-wing Democrats want to do. They want to put us on par with Europe, and Europe has many fewer tax incentives for business owners and investors, so they still have them, but they have many fewer incentives, especially for investors, real estate investors, than the U.S. And Biden would really make it more consistent if he got his way with Congress, more consistent with the European. I don't think that's going to happen because, Biden probably, if he has a Democratic House and Senate, he probably has it for 2 years. That's been what's gone on for the last decades. So he probably has it for 2 years. And then people say, we don't like having everybody in the same place. What'll happen is at that point, in 2 years, he can raise the rates, but I don't think he can make massive changes to the tax law and get them through. That's a pipe dream for him.
That's a good point, because every 2 years you have these interim elections where people seem to want to bring it back the other way, who the opposite of the incumbent is. What about our ballooning national debt? I mean, how many presidents and how many Congresses are really giving regard to that? It seems like a lot of them are long-term incentivized to not want us to have austerity because no one wants to live in impoverished conditions under their watch. I mean, is there really any incentive toward reducing the national debt, truly?
Trump and Biden, this is probably the one place they don't think the national debt is important. Either one of them does. Trump has very much done more to increase the deficit than any president in history. He clearly doesn't care about the deficit. There's this interesting theory, this modern monetary theory. Their theory is that it doesn't matter. It's scary to me. It's an interesting opinion that can you get away with deficits forever as long as everybody has deficits? So as long as it's not just the U.S. government, but it's also the Chinese government and the European government, everybody has deficits. Can you get away with it forever? Maybe you can. I don't know the answer to that. It sounds bizarre to me. I think it's a little scary to me, but I don't know. We have not had a president really concentrate on the deficit, interestingly, since Clinton. Obama did a little bit because the Republicans have been the ones that have blown up the deficit. It's not been the Democrats. So it'll be interesting to see what happens if Biden's elected.
Almost every president seems to run up the debt. Well, Tom, you are an expert at helping people permanently reduce your taxes. You've been doing it for a long time, especially for real estate investors and business owners. If someone wants to learn more about that, what's the best way for them to do so?
They would go to wealthability.com. Wealthability is just like it sounds.com and just schedule a call with us where I would help. I don't know if you know this, Keith, but we now have a network of over 50 CPA firms around the world, and we're growing every day in our network. We use the Wealthability system. So I always say it's a combination of having the right system with the right advisor. And we've actually training the advisors by themselves. They can't do it, but with our system, it's been working. If you're interested in a great system for reducing your taxes and a great advisor, come to wealthability.com. We'll help you any way we can.
And you've really been building up the number of members in your network over the past few years. That's wealthability.com. Tom Wheelwright, thanks so much for coming back onto the show.
Thanks, Keith.
Oh, great insight from Tom, as always. Roughly 80% of Biden's proposed tax increases would fall on the top 1% of earners. That is according to an analysis by the nonpartisan Penn-Wharton budget model. Middle-class families would be largely unaffected by Biden's tax plan. Again, that is per Wharton's analysis. Now, when it comes to states, California and New Jersey have notably proposed to raise taxes on the wealthy. That could only create more flight into low-cost, low-tax parts of the nation, notably the Midwest and South. I was writing to you about this in our recent Don't Quit Your Daydream letter. Bottom line, when the economy goes south like it has recently, states don't hesitate to raise taxes. In fact, following the Great Recession, at least 10 states raised taxes in the following years to shore up their finances. Now, do you feel like taxes are too high right now already because government is too big and neither candidate would do enough about that? Well, if you feel that way, voting is about more than just Republican versus Democrat. There's the Libertarian Party too. Libertarians basically believe that the smaller the government, the better. Jo Jorgensen is the name of the woman who represents the Libertarian Party for the upcoming November 3rd election. Her first name is spelled J-O. Jorgensen supports replacing the Social Security system with individual retirement accounts. She supports cutting government spending to reduce taxes. The Libertarian Party candidate has finished third in each of the past few elections. but they are moving up in the results as more voters are getting fed up with the two-party system. In fact, 2 presidential elections ago, the Libertarian candidate, Gary Johnson, he got just 1% of the vote, but last election he got 3.3% of the vote. So last election, 2016, therefore, fully 1 in 30 voters went Libertarian, and Joe Jorgensen is the one that carries that flag this year. Libertarians want less government, and then there are more than just 3 parties as well. So you can look into that more if that happens to interest you. Today's show certainly is not any sort of voting guide. We are more focused on the financial and tax elements of an administration's platform here. This is an investing show. We don't get political here. And in fact, this is about the most we cover the topic. The reason that we're doing it now is because this is a quadrennial event. A presidential election only takes place every 4 years. If Trump loses on November 3rd, realize that he will be the first president since George Bush Sr. to not secure a second term. That was back in 1992, almost 30 years ago. Well, where do Trump and Biden have some common ground? They both won infrastructure bills worth more than $1 trillion. Republicans do not want infrastructure spending inside of coronavirus stimulus bills, and Democrats do. Understand that Biden's plan focuses on climate change as well. One of the most important things that I can tell you is that, yes, these things do make a difference in your life. I mean, that's why we're talking about them. But often, your next president will not make a world of difference in your life. It might steer or tweak your behavior. But look, few sane people would say, for example, oh, you see, I didn't launch my business 12 years ago because Barack Obama beat John McCain in the election. See, that sentiment, thoughts like that does not age well. So think long term and keep some perspective. The most important person by far in building your wealth and your finances is you. And that most important person in steering your family's values is you. Learn more about permanently reducing your taxes with Tom at wealthability.com. Big thanks to Tom Wheelwright. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.